We can also look at data from a historical perspective. That is, how has the company done in the recent past? So if we're going to use historical data, we need to know, well, what kind of data do we need, right? So typically we use 48 to 60 months, 4 to 5 years of monthly data, or you could use 52 weeks of weekly data, or you could use some shorter periods if you're using daily data. But if you're looking at long-term types of analysis, how will a stock, perform for the next 5 to 10 years, we should probably try to stick to this 48 to 60 months of monthly data. We obviously need to calculate some statistics. So the formulas for average return and the standard deviation are obviously a little bit different from the prior ones, but it's actually a little bit easier to do from the perspective of Excel, right? It's just equals average, and then you have the sample data. You highlight that, it will calculate the average, and then you want STDEV, and the sample data gives you the standard deviation. So here we have some statistics from 3 companies. Well, 2 companies and the stock market. So here's the market, here's Blandy, and here's Gourmand. So these are the percentage returns over the last 10 periods. So we would like to look at the statistics. So let's look at, again, putting this data, enter the data. The spreadsheet that I'm using here is in the workbook, risk and return workbook, and it's under the historical returns worksheet. You just enter the data, and then you do have to put the number of data points, since especially when you're using this historical data, we have to worry about the significance points, right? So you have to know the actual number of data points. So in this example, we see what Blandy's at 6.4, Gourmand is at 9.2, the market itself is at 8%. So what is the standard deviation? 25, 38, 20. What about the coefficient of variation? We find that the market is the least risky, followed by Blandy, and then followed by Gourmand. We can use what we refer to as the 95% confidence intervals. What this does is gives us a picture of risk, right? So for Blandy, there's a 95% chance that return is going to be between negative 0.43, it should be percent, and 56%. For Gourmand, between negative 66 and 84%. You can see what a wider range is indicative of more risk. Now, what do we do with portfolios? Well, the formula is very similar to the portfolio for predicting returns, except now the W is this weight. It's the proportion of funds that are invested in that particular asset out of the entire portfolio. We also need to look at, in this case, if we put 25% of our money in Blandy and 75% in Gourmand, what will that rate of return be? Well, again, we can calculate this a couple of different ways. In this case, we want to calculate the portfolio of Blandy. So this number, 31%, is 25% of Blandy, 75% of Gourmand. Add those together. Then you calculate the rate of return per period, and then do the statistics on that return. Now, in this worksheet that I had shown you, right below where we calculate the basic statistics, we can actually create, again, portfolios. So in this case, This might actually be backwards. 75% was in A, which I believe is Blandy. 25% was in Gourmand, and then 0 was in the market. So the average rate of return for this, 7.1%. Standard deviation is 22, and the coefficient of variation is 3.12. Again, once we start combining the assets, we need to understand what's happening with the risk. How is the risk being affected? So let's see what happens here. The average rate of return for Blandy was 6, Gourmand was 9.2, 75-25. The return, since there's only 2 assets, the return is going to be somewhere between the highest and lowest of those assets. If you had 12 assets, the average is going to be somewhere between that return of the highest asset in that portfolio and the lowest portfolio. It's a weighted average. But what happens when we look at risk? Blandy is 25% risk. Gourmand is 38% risk. But the portfolio is 22% risk. So the portfolio has less risk than either one of the components of the portfolio itself. How can you put 2 risky things together and get less risk? It's because the formula, the calculation of standard deviation for a portfolio is more complicated. It's not just a weighted average. There is a statistic that's referred to as the correlation coefficient. Loosely speaking, the correlation coefficient measures the tendency of 2 variables to move together. So it's a fairly complicated formula, but when you look at Excel, it's actually pretty easy. It's equals Correl, then you highlight the first stock, and then you highlight the second stock, and it will calculate the correlation. So the correlation between Blandy and Gourmand is 0.11. Blandy and the market is 0.48. Gourmand and the market is 0.67. So we see that the correlation has to be between a +1 and -1. And this is just some basic statistics here. Has to be between +1 and -1. If the correlation was equal to +1, there would be no reduction in risk. Essentially, you'd be investing in 2 accounts with the exact same assets in both accounts. So whatever happens to one account is going to happen to the other. There's no reduction. But as long as the correlation is between -1 and +1, I need a plus here, -1 and +1, sorry. If it's between -1 and +1, then risk will be reduced. Not eliminated, but it will be reduced. What happens when we add stocks to portfolios? So let's take a break and just take a step back and think about, why are we talking about investment portfolios in corporate finance? A definition of a corporation is it is a nexus, a portfolio of projects. Every asset the company buys is a project. So if a company adds another asset, could be another company. A while back, P&G purchased Gillette. Well, Gillette was a separate entity. They had their own stock. We're going to buy that company and now put it into my corporate portfolio. How does that affect returns, number one, but also how does it affect risk? The answer to that is all about the correlation. So let's think about what happens when we add stocks. Remember, anything less than +1 is going to reduce a little bit. As we get lower and lower correlations, diversification will increase more and more. But as we add more and more stocks, those interactions, they all interact with each other. So the more things you add, the quicker risk is going to ultimately be diversified away. So here we have a portfolio of stocks. Let's refer this, let's just call these domestic stocks. These are, let's say this is an investment in the New York Stock Exchange. So this study was done in the early 70s, I believe. But what they did is they went out and they took all the stocks in the New York Stock Exchange and they calculated the risk, the standard deviation for each stock. So a one stock portfolio had a standard deviation of roughly 35%. So then they says, okay, now let's start creating portfolios. So they created 2 stock portfolios with equal weights, 50% invested in each, and they then calculated the return, the risk of each portfolio. And they randomly chose the portfolios, and they did this thousands of times. Then they found the average, and the average of that 2 stock portfolio dropped. Why did it drop? It dropped because those 2 stocks, by definition, let me go back. Most stocks are positively correlated with each other because they are all pretty much positively correlated with the stock market, right? So if there's, as long as it's not +1, there will be some risk reduction. And then they added 3 and 4 and 5. And every time they added a new stock, they found a reduction in average risk. So what was going away? The thing that was disappearing is this diversifiable risk. Sometimes we refer to it as company-specific risk. There is a point, though, where we get to a certain point where risk doesn't reduce anymore, or at least not dramatically. So that's somewhere, depending on when you look at this study, somewhere between 30 to 40 stocks, you will find the least amount of risk possible. And the risk that you see will almost entirely be market risk. So you cannot add another thing and reduce the risk more. So how this might work, let's expand this just a little bit. What if we added the bonds to this portfolio? What's the correlation between stocks and bonds? What you would find is it's typically negative. So if you created a portfolio with stocks and bonds, how would that address this? So what would happen is you would have a decline, and then again, it would get flat, right? So combining stocks and bonds, domestic stocks and bonds, we get a lower market risk because we've added a financial asset. What if we added international stocks? Again, we're going to see another line come down. Again, the point of this is when you start combining portfolios with different types of asset classes, you get different types of diversification because each one of those asset classes has a different correlation with each other. But eventually, you'll get up to a point where you probably have the least amount of risk possible given those assets that you've chosen. So the graph that we just looked at says, look, standalone risk, right? This is a standard deviation. Sometimes we would just refer to this as total risk. Has 2 parts, market risk and diversifiable risk. Market risk is that part that we cannot get rid of by diversification with the assets that we have. Firm specific is that part that is eliminated through diversification. So what are our conclusions? As more stocks are added, each new stock is going to reduce risk, but at a smaller impact. So risk falls very slowly after about 40 stocks. So you would think that if 40 stocks gave you the least amount of risk, then investors should own 40 stocks in their portfolios. If you can create a well-diversified portfolio, you can eliminate about half the risk of owning a single stock. So this is very important. Think about investing. Think about investing in your 401k. Most of us who invest in our 401k are investing in mutual funds. By definition, these mutual funds have at least 20 stocks. Some may have a lot more. They could have 60, 70, 80 stocks, depending on the size of the mutual funds. So they're going to be a very well diversified portfolio. So you're going to have, when you buy one, given the assets that are in there, that's the least amount of risk that you're probably going to be able to get. So can an investor holding one stock earn a return commensurate with its risk? And the answer to that is no. Rational investors are going to want to minimize risk. They're going to want more. So investors bear only market risk. That's the only risk that prices and returns reflect. So the standalone risk of an individual stock is not the risk that we want to measure. We want to measure another form of risk. But again, let's kind of go back for a second. This doesn't mean anything at all with respect to the return. So imagine you invested in, if we went back to our company, this is, let's go back and look at the return here for, excuse me, I want to look at the data. Oops, I'm sorry. I'm trying to find it here. Here we go. So if you put all of your money in Gourmage, you'd earn on average 9.2%. So if that's your only investment, is that enough return? And the answer is the only return you're getting paid for there is the return of the market risk of that individual asset. But that individual asset has a lot more risk, a lot more standard deviation. So we need to diversify so we can eliminate as much of this company-specific risk as we possibly can. Again, the prices that you see, the returns that you receive, all come with an assumption that you have a diversified portfolio. So how do we measure the amount of market risk in a stock? Well, in the next video, we're going to talk about a theory called the capital asset pricing model. And when we get there, we'll answer that question. Look forward to talking to you soon. Bye-bye.